Hi, I'm Steve Dudash, IHT Wealth Management. Welcome to this week's Wealthcast. I want to do some math with you guys, some quick math, some cheater ways of you guys to know, and I bet you many of you already know this, but I just want to make sure we're all on the same playing field. There was an analyst who came out earlier this week and said the market's going to double in the next 10 years, and they were making a big deal about it, and people were talking about it over and over again. And it got me to thinking that most people probably don't realize what that actually means. So a trick of the trade. It's called the rule of 72. Many of you probably already know this, but the reality is you take the number 72, take whatever your rate of return is, divide it into 72, and whatever that number is how many years it takes you to actually double your money. So if you're averaging, let's just say 12% a year, okay, which is really high, don't expect that, but just pretend you're making 12% a year. 12 into 72 is 6, so that means it would take you 6 years for your money to double. If you average 8% a year, 8 into 72 gets you 9, that means it makes 9 years for your money to double. The point here is for someone to say it's going to double in the next 10 years, that means the market only has to do a little more than 7% a year, which historically would be a very bad decade. A normal decade, in the past, say, 100 years, is averaged about 10%. So if he's coming out here and saying the market's going to double in the next 10 years, well, that means he thinks it's only going to do 7% a year, which would be underperforming by a little more than 3% a year over that period of time, which is a big deal. Now, the truth is, I agree with him. I think the next decade, 7% is a very realistic number. I don't think 10% is very likely given where we're at in kind of the economic cycle of things. But I just want you guys to have some perspective on what that means. To double in 10 years is not a reach. In fact, it's an underperformance of historic standards. And I wanted you to know how that math works a little bit. Again, we're only talking about if someone's all in stocks. If you have bonds, bonds do dramatically smaller numbers, especially in this rate environment. So it kind of skews your, if you're half stocks, half bonds, you're not doubling in 10 years. You're just not. Because your bonds are only going to do like, say, 4 or 5% over that period of time, if that. So, but just a little perspective on it. Nothing too exciting, a little math heavy this week. On that note, I also want to just a little shout out to our friends in the Carolinas, Virginia, Georgia area. Be safe this weekend. It looks like the hurricane's going to be a little bit less than what was originally being said, but still, you know, be safe. We're thinking of you, and I hope come next week we're all talking about how we're getting back together and pulling things back together, rebuilding. So have a nice weekend, take care, and we will talk next week. Bye.